Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager at Barometer Capital, and I thank you so much for taking the time out of your afternoon to join us again for another Barometer Readings webcast. Joining me today, as always, is David Burrows, our Chief Investment Strategist and President at Barometer Capital. On today's webcast, we will provide you with a brief macro overview and, of course, look forward to addressing any of your questions. So don't be shy, email me, phastings@barometercapital.ca, or hit me up on the Zoom chat link. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pam. How are you?
I'm great. Thanks, Dave. How are you?
Just great. Thanks. It's good to be here in the Barometer office. We've got folks back at work over the last couple of weeks, and so we'll see how many we get in here over the next 2 or 3 weeks.
Absolutely. Looking forward.
I want to thank everybody for joining us today. We've got a bunch of stuff that we're going to try and get through. It's been a choppy week in the market. Lots of things having an influence. Certainly, energy prices having an influence. Inflation having an influence. The ongoing war in the Ukraine having an influence. And we have a very interesting market. It's very bifurcated. There are things that are working. There are things that are definitely not working. And this has been a market where it really is paying to be focused and targeted, because there are big parts of the index that are having difficulty. So with that, let me just blast through a few sort of introductory slides. As people know, we believe we're in a structural bull market in equities led by U.S. markets. They kicked off the structural bull market in 2013 when we exceeded the highs from 2000. And since then, it's been sort of 3 steps forward, 1 step back. There certainly have been interruptions along the way, but these things go on a long time. To put it in context, we've now been about 150 months since this bull market began. The one in the 1980s and 90s lasted just about 216 months. So it's almost a 1,200% return over the period. We're nowhere close to that over this most recent period, less than half. But certainly the corrections that we've seen are commensurate with what we see in structural bull markets. They certainly are painful, but at this point, what we're seeing over the last few weeks has been very typical for a structural bull market. We have to digest gains from time to time, and that's what the market has been doing. On rates, we've had a belief that we've been going through a structural bottoming in interest rates, much like we did in the late 1940s, early 1950s. And these things take time, and they come in fits and starts, but it is becoming clearer that that is the case. And that's important to keep in mind, because what works during structurally falling interest rates or a disinflationary environment is really very, very different than the things that work from an investment standpoint in a reflationary or an inflationary environment at times. So that's important to distinguish. We always believe you have to have a good, solid view as to what the structural backdrop is, because we have to behave differently in structural bull markets and structural bear markets. On rates, this is the 10-year yield, going back to the lows in the early part of the spring of 2020. And since then, we've been working our way higher. We had a first leg higher, a consolidation period, and a sharp move higher in rates over the last few months. Today, this morning, we're trading at 2.8% on a 10-year bond. That's up from 33 basis points in March of 2020 at the pandemic low. Now, one thing that we always like to point out and that we always keep in mind is that a sharp move higher in rates will have often difficult implications for other asset classes. There is a mountain of debt outstanding, and sharply higher rates can make a difference to investor confidence. We're okay with rates that are moving slowly higher. A sharp move higher can have an impact. Now, there's reasons why rates are going up. Certainly, the Fed has made it very clear that they plan to fairly aggressively raise rates as they try to rein in inflation. This is a chart of rents in the U.S. coming from Zillow, up 17% year over year, which is obviously a giant move in the cost of living. And this is food inflation. This comes from the UN, and this is global food costs. And in the month of March, globally, food costs were up 12.6%, and you can go back a long ways and not see anything like that. So these have been important themes in the market, and we think that they are themes that can go on for some time. When you get sharply higher food prices, they can be sticky and continue to move higher for periods of time. And these are things that we're watching, but it does have an influence on the bond market. This is the aggregate bond index as seen through the eyes of the AGG ETF. Since the aggregate bond index peaked, and that's made up of multiple issuers, multiple maturities, multiple credit qualities, that index is down 13.09%, going back to August of 2020, and it has just continued to do so. When we look at the TLT, which is the long end of the US bond market, the ETF that owns 20 to 30 year bonds, it's now down 32% off the highs. A very difficult thing for bond investors to stomach. But I will point out, while we are structurally bearish on rates, meaning we think that rates can continue to go higher, we've had a very sharp move recently, which has had implications for other asset classes. But I do point out that at the worst point of the first move down into the spring of 2021, the market got 16% below the 200-day moving average. So that was extended, and then the market corrected. We note that as of today, we are again 16% below the 200-day moving average. We've had a very sharp move lower. Things don't move in a straight line. And this is important because this week, the Fed is auctioning $124 billion worth of bonds that mature. And often coming into a bond auction, bond investors will lighten up their positions to have the capacity to take the new issue. So it may be in the very short run, we're seeing a crescendo in this recent sell-off. That would have positive implications for equities if the pressure were to come off. But certainly as a bond investor, and there's a mountain of them, they're not having a very good experience recently. As most know, we've been quite bearish on bonds over the course of the last 18 months. To put it in context, this is 10-year bond yields going back to the early 1980s. And there have been lots of rallies along the way, but each one ultimately has failed. Now, you can see that there's been a downtrend in rates going back to the early 80s. And in the last 2 weeks, we have broken above this range, which gives us additional view that we have in fact seen a structural low in interest rates, and the trend is changing. But you can also see why we watch this very closely, because there have been many difficult periods in the stock market associated with sharp rising rates. So this is one again that we're watching, and we're watching specifically sectors that get negatively impacted by this. And of course, we always take our cue from market. But this is one of the reasons we watch so closely the bond market, not necessarily because we're long the bond market, but we want to make sure we understand the knock-on effects. This is not something that's just happening in the US. We put this chart up last week. This is 10-year yields from countries all around the world. We put up a chart about a month ago that Germany, the same as the US now, had broken the downtrend in rates going back decades. And this was really an important turn. So this is the iGov ETF, which is international treasury bonds. It's down 20.1% from the high. Again, very stretched away from the 200-day moving average, could certainly bounce at any point in time, but very clearly in a downtrend as measured by all moving averages. Just you can notice that we're getting sold out on some of the indicators. So fixed income continues to be sloppy. Let's move back to commodities. We've talked about how we believe that commodities made a secular turn back in the early part of 2020 after years and years of negative performance, and even worse, underperformance versus stocks. They have been marching higher monthly. These are monthly bars since then, with small consolidations along the way. And again, here we are halfway through April and moving higher, putting in a higher high. So clearly this continues. To put it under a little bit more of a microscope, this is that same RJI equally weighted commodities index. We talked last week about how it was consolidating. And yes, it has been consolidating, But as of today, we're breaking up out of that range, which again points to further higher prices. So we're still very early days in relative outperformance of commodities. This is the Goldman Sachs Commodities Index versus the S&P after underperforming all the way since 2008 until the middle of 2020 and now showing outperformance. Still very, very early days, and we think this can go on for quite some time. But no sign whatsoever this is changing. When we look at oil, oil broke out of a range going back to the beginning of 2014. It is in a wedge pattern similar to that overall commodities index. My guess is we probably will come back out of that wedge to the upside. And frankly, the measurements are quite a lot higher. Natural gas, this is a weekly chart. Last week, we pointed out that we had made a new weekly high, and this has continued to move sharply higher up again today. This week, we're up almost 5% on the week. This is metals prices. Again, in that same sort of wedge pattern, you can see the relative strength versus stocks is moving sharply higher. This is relative strength versus the S&P 500. So commodities in general continue to work their way higher. We've been asked a lot about gold. We talked about how it had consolidated after going through a long bear market, and it has broken out of that cup and handle formation, again, pointing to much higher prices. Agricultural commodities. This is the equally weighted agricultural commodity ETF. You can see now trading again, especially over the last couple of weeks, but nice move higher relative to stocks. Agricultural commodities not showing any sign of backing down. Now, these were conditions that were in place prior to the Ukraine-Russia conflict. So I want to make it clear, the supply-demand picture after a multi-year bear market, supply becomes constrained because people don't make new investment, new capacity. When demand ultimately overwhelms supply, it can take a long time for new supply to come on. Now, post, of course, the beginning of the conflict with Russia-Ukraine, I think investors have recognized that Ukraine is a very, very important supplier of grain in the world. This is their corn crop. Expectations are that this year they will supply less than half of what they did last year, and they account for about 19% of grain production globally. This is the corn ETF. Looks a lot like that gold ETF. Same thing, but this is a shorter term picture as it consolidated over the course of May of 2021 through the end of 2022. We moved higher, consolidated, and much like some of the other commodities breaking out of this consolidation and moving higher. So one of the rules that we follow is that things that are in motion tend to remain in motion. It's why we care about relative price performance versus the market. It's why we care about trend following. It's why we take our cue from the way the market is behaving, not the way we think it should behave. Certainly, all of these commodity prices have moved higher, but it is more likely the beginning of something than the end. And we always want to test to say, do these themes continue to be in place? And whether it's energy, whether it's metals, whether it's agriculture, all of these trends after recently consolidating look like they're continuing higher. We remain in a structural bull market in commodities. Let's talk equities. In the near term, equities have been going through some indigestion. So this is the period October through current for the S&P 500. We made a series of tests at lows, the end of January, the end of February, the end of March. And we rallied back to above the 200-day moving average. But in the past week, as bond yields have moved sharply higher, again, equities have come under pressure. Now, remember, the S&P is made up of 500 companies, and there are different sector weights that have different kinds of impact on the index. If we look at this and we deconstruct it, we know that a very significant piece of the S&P is technology, and technology has been under pressure. We know, on the other hand, that energy and materials make up relatively small parts of the S&P, and their strength isn't so much showing within the index. But as it sits, the S&P over the past week broke back below the 200-day moving average, and it's something that we're watching very closely. We do note that while the S&P has been weak, the pickup in volatility has been at this point quite muted. So this was the high in March in volatility, the high in February, and the high in January. Each made a lower high, signaling the market was healing. We think it continues to heal in general under the surface. Even this week, the equally weighted S&P 500 has well outperformed the cap-weighted S&P 500, which is so heavily dominated by those large cap technology stocks. Other things that we keep in mind are credit risk, the cost of credit to corporations versus what it would be for a government. And we can see that credit spreads on investment grade and high yield bonds continue to come in this week, meaning doesn't appear to be concern in credit markets about credit quality. Now, a few weeks ago, we put this chart up, and it was a chart in red of the price of the TLT, the long end of the US bond market, and how tightly correlated it was with the NASDAQ 100. So when the TLT was doing well, meaning rates were falling, growth stocks tend to do quite well. And when rates are rising or bond yields are falling, bond prices are falling, it makes it difficult on growth stocks. So we have to discount their future cash flows back to the present at a higher interest rate. Well, this divergence that we saw in the early part of March with a sharp rally in the NASDAQ versus weakness in the bond market, we thought was problematic. It would be unlikely that the NASDAQ would continue to rally if the bond market continued to weaken. Well, as it turns out, the NASDAQ 100 is weakening back versus the S&P. In fact, making again a new low on a relative basis versus the S&P. So this has not been a rally to chase in growth stocks. This is the ARKK ETF, Kathy Wood's ETF made up of highly innovative but unprofitable technology stocks. It now has a relative strength versus the S&P of 11, meaning it is trading worse over the last year than all but 11 of the S&P 500 companies. Okay, let's talk about this week's data. Important data today, inflation data. So CPI came in as estimated by most economists. They were expecting between 8.3 and 8.6%. It came in at 8.5% at the high end of the range. So we can see these are multi-year highs in year-over-year inflation. This again has implications for the bond market, has implications for investors. It has implications especially for those that are sitting with cash, because we know the cost of living is going up quite dramatically recently. Some of it may be transitory, some of it may be structural. When we look at headline month-over-month CPI, again, a very significant move higher, about 1.3% even month-over-month. Remember when we were looking at CPI moving at 1.1 or 1.2% over the course of a year. We know that some of the increase in the CPI has come at the hands of a few sort of more idiosyncratic moves, the price of used cars and new vehicles. Actually, year over year, the price of used cars is up almost 40%. This is not something that's likely to continue as the supply of new autos comes back to the market over the next couple of years, but certainly it's had an impact. So inflation in used cars and new vehicles, significant. Lodging away from home, significant. Car and truck rentals having an impact. Public transport having an impact. The core of CPI coming in at a plus 3.5%. The next thing we have to consider is what's going to come out of earnings. So we're now into the reporting period for the first quarter earnings. Of course, we want to know how are our companies doing, how's the market as a whole doing versus estimate. So coming into the quarter, we've had the first quarter earnings estimates revised lower by 1.5%. So that's the first time we've seen revisions lower over the last few quarters, and that's important. But I would point out that historically, first quarter earnings are revised lower. In fact, this has been the first quarter average trend over the last many years. And this was this year's revisions lower. So in fact, while they've been revised lower, it's actually been much better than we've seen in the average of the recent number of years. So ultimately, at the end of the day, we care about inflation, we care about earnings, we care about things going on in the Ukraine, we care about what's going on with oil prices, we care about what's going on in China and COVID, but we have to take our cue from what the market is doing relative to all that news. The market's a machine with 1,000 moving parts, and ultimately price behavior in the market comes out of the digestion of all of that news. Investors move with their feet. So we care what's happening with breadth. And over the course of a cycle, when we go through a decline, the weakest stocks sell off first. And then if it continues, stronger and stronger stocks get impacted until late in the decline, almost everything's getting hurt. What we care about is what parts of the market are seeing expanding breadth. We'll see expanding breadth often before you see a low in the market. And then as a trend catches hold over time, a higher and higher percentage of stocks will participate. So in a healthy environment, we want to see expanding breadth. And during that time, we'll focus on sectors or themes that are also showing expanding breadth. When we start to see deterioration, either at the market level or sector level, doesn't mean we're going to sell everything, but it does mean that for those groups that are seeing deterioration in breadth, we can't add any new positions. We're going to tighten up the stop losses that we use underneath our current positions, and we use stops on all of our positions. As the position works out, as we hope or expect, we'll gradually ratchet the stops higher. And ultimately, when we start to see deterioration, we'll tighten the stops, we'll raise a bit of cash, and we won't put any new positions on. So this week, some of the data weakened. The percent of stocks in the NYSE and uptrends did move down about 6%, enough to turn our model negative. Percent of stocks trading above the 50-day moving average moved lower. Percent of stocks with positive weekly price momentum or upward trajectory moved lower. The percent of stocks making new highs versus new lows moved lower. And the percent of stocks trading above their 150-day moving average also moved lower. Now, globally, actually, all of these indicators remain positive. So my guess is the major moving part that is different is that the US has had very sharply higher interest rates. Canadian breadth also remained positive, and the Canadian market relatively benign versus what happened in the S&P and the NASDAQ. But these are all important things. And what it means is we don't put any new positions on in the US. It means that we tighten up our stops. If our positions continue to work well or hold up in price, we're going to stay invested. But to the extent our stops get hit or new money comes in, it's going to sit in cash and wait till these indicators start to show improvement. There's no use in fighting the market. So globally, we have some global positions that are working quite well. As most people know, we have over 65% of the portfolios that we manage currently focused in Canada. It's our local market. It's performing better than the US market. But for the US, it does have implications. As I showed last week, world bullish percent had moved up from 32% to 46%. As of yesterday, still sitting at about 46%, meaning the percent of stocks in uptrends has been rising. Canada is very similar. This is the Canadian market as of about 2 o'clock this afternoon, trading very close to new highs. This is relative price performance versus the S&P since the beginning of the year. As you can see, sharply higher. Today, down just a fraction of 1%. So let's go and check on leadership themes. What is it that people care about? Where is money getting put to work? Where is money leaving? And then how does that relate to the portfolios that we're managing? So for many weeks now, the largest positions in the firm have been in energy. This is the XEG, the S&P TSX Capped Energy Index, made up of both oil and gas producers. And you can see today trading at a new relative high versus the S&P and a new absolute high, a new all-time high. When we look at the XOP, The energy, oil and gas exploration and production companies, again, rising relative strength, new high versus the S&P. Nothing wrong here. This is the point and figure chart for that same ETF. What we always care about is higher lows and higher highs, continues on. And in fact, we talked in the team many weeks ago, but the initial target is much higher than where we are today, perhaps as much as 30% higher when we look at the technical factors around what's going on in this index. That would be very significant for the Canadian market, where energy is a much larger weight than in the US. The oil services sector, the drillers and the service providers, look very similar. Again, a much higher target than we sit today. We've consolidated actually over the last few weeks, but on the verge of breaking out of that consolidation, a lot like those triangle patterns we've seen through almost all of the commodities. The reason I talk about these is a triangle formation, or when a stock consolidates in a tighter and tighter range. When you break out one way or the other, you tend to have quite a sharp move in that direction. And it looks as though we're breaking out to the upside. So energy continues to lead the market. And it's not just oil and gas, uranium prices moving smartly higher. Certainly the uranium equities like Cameco and Next Gen Energy are moving very nicely and trading, making new relative highs versus the S&P. Moving beyond energy, next theme we've talked about for quite some time is metals. Supply demand in copper and nickel and aluminum and steel for that matter, very, very tight. This is made up, this ETF, of base metals producers, steel producers, and gold producers. As of today, 3 o'clock in the afternoon, making a new relative high versus the S&P 500. This is the steel ETF, relative high versus the S&P 500. This is the gold ETF, the GDX gold miners. A new relative high versus the S&P, has moved sharply higher over the course of the year, continues to act quite well. So with commodities, the commodity producers are actually outperforming the commodities and continue to look quite attractive. There's the gold miners point and figure chart. Same thing, you can see we've taken out that triangle formation, made a higher high, a higher low, and another higher high. In fact, taking out the highs from the middle of 2021. So we got asked a few months ago why on earth we had this large precious metals weight in our macro portfolio. Our view was that the setup was very, very constructive and one that was worth waiting for. And we think that certainly this is underway. When you take the agriculture equities, this is the DBA, which is the agricultural commodities ETF. When we look at the companies in the commodities in the agriculture area, they continue to act quite well also. Again, today, making a new relative high versus the S&P. So really across the basic materials space, and this is the basic materials ETF, new relative highs today, continues to perform well. As an asset class, commodities and basic materials continue to lead, probably are the leading asset class globally. And that's after 15 years of underperformance. Moving beyond basic materials and energy, defense continues to hold in well, almost at a relative strength new high versus the market, held in very, very well versus a weak stock market, and certainly well versus a weak industrial sector. But these are companies, Raytheon, Lockheed Martin, Boeing, Textron, companies within the defense space. Okay, moving along. The next common theme that has been doing well at a time of uncertainty have been the dividend paying stocks. So some of the areas within REITs, particularly residential REITs, you can imagine with rents moving so smartly higher, that the residential REITs are probably doing pretty well. They're made new relative strength highs today versus the S&P. Utilities with their predictability, making new relative strength highs. Consumer staples, again, with their predictability and ability to raise price as their base costs go up, making relative strength new highs. And if we bundle it all up, the FDL, the Dividend Leaders ETF, which we've talked about many times, again, making new absolute highs this week and new relative highs versus the S&P. So clearly there are winners in this market. It just happens to be that they're relatively small parts of the index. so not helping the S&P itself all that much. There are some things that aren't working. 2 weeks ago, we talked about the fact that while the S&P had rallied, the bank index hadn't. And this has been a group that we've been reducing weight to over the last 6 weeks. This week, the banks continued to weaken. So the KBE's now moved from $60 to $49. It's making a relative strength new low for the year, actually going back to November of 2020. And there's a couple of factors here. First of all, the shape of the yield curve makes a difference to banks. When you take in deposits at one rate and lend them out at another, you make a spread. If the differential between a 2-year bond and a 10-year bond is flat or indifferent, it's hard to make a margin. But also when you have sharply higher rates, there are some who are concerned that this could push the economy into a recession. Whatever the reason, banks started weakening in the beginning of January on a relative basis for the S&P, and this is a group that we've had to back our way out of. Moving on from financials, many areas within industrials have had a difficult time. In particular, some of the favorites over the last few years, robotics, have moved sharply lower, now have a relative strength of less than 35, meaning in the bottom 35% of performance in the S&P. We've got weakness in transports, moved sharply lower over the last couple of weeks on higher energy prices. And we have weakness also in consumer discretionary. This is an equally weighted basket of consumer discretionary stocks. Inflation taking a toll, perhaps, on a consumer. Now, we'll have to see how consumer companies report when the earnings come over the next 3-4 weeks. But as it sits right now, the market's telegraphing concern about the consumer's ability or willingness to spend. Moving beyond consumer discretionary, the communication stocks, which we've avoided for many, many months, sharply underperforming the market, and the large cap technology stocks that we've talked about. So lots of things that aren't working. It really means we have to be targeted. Sticking with the income theme, this is the Canadian Equity Income Index. It actually made a new high this week and a relative high versus the S&P. So at the end of the day, we don't have to be everywhere. We have to target. Our job is to focus on areas of market leadership. Leadership means things that are relatively outperforming, things that show expanding breadth, things where we can see, based in fact, there is new money working its way into the sector or theme. Now, the world changes. We always have to ask the question every day, has anything changed? So when we use these breadth models that we calculate daily across 41 industry groups, all of the major global markets, each major asset class, all of the structural basic themes, we ask the question, is there new strength? Is there new weakness? And how does it affect our portfolio? We have zero problems being completely out of certain industry groups. We have zero problems holding cash, if that's the best thing to do. And we have zero problem being invested when it's scary, if breadth models support it. It is a tactical approach. As we sit today, as you can imagine, our portfolios look nothing like the index. The S&P 500 has about 4% of the index coming from components coming from the energy sector. As a firm, 26% of our assets are in various parts of the energy ecosystem. That includes pipelines, it includes oil and gas producers, and it includes uranium, it includes solar. All areas of energy are performing well. And this is a sector that's underperformed for a long period of time. Materials make up 2.6% of the S&P. We have close to 25% of our assets in hard assets. Hard assets are benefiting from inflation. Consumer staples companies have had an ability to raise price based on their brand awareness, and some of the companies better than others. We have 10% of our assets here. We're getting a great dividend stream. We have a 7% position as a firm in fixed income, and that comes largely from our balanced mandates that have to have a minimum 25% in fixed income. but it's all short-term bonds and high-quality issuers. Industrials make up 6% of our assets, but it's largely in the defense sector, where long-term contracts with inflation protection give these companies lots of defense. Financials are down to 5% of our assets as a firm, and it's largely insurance companies, which are well outperforming banks and regional banks. Utilities make up 4%, just about twice the index level, and you can know that this has been building just very slowly as a predictable source of income and defensive against any kind of economic slowdown. Communication services, relatively small. This would be some telecom exposure in Canada. Real estate investment trusts, about market weight. Technology, exceedingly low versus the benchmark. Consumer discretionary, exceedingly low. And healthcare, exceedingly low. Look, as it turns out, I think most portfolio managers are having a difficult time. And by the grace of God, our process has been working quite well. The average hedge fund in the first quarter was down about 6%. It was about the most difficult quarter that hedge funds have had in the last 10 years. As we sit today, I'm sorry, the date's wrong here. This is as of today. I guess it's April the 13th. The equity pool is up about 0.27 of 1%. Our balance pool is up about 3% year to date. The tactical income pool, which was down a month ago, about 4.5%, is now down less than 1%. Our long short portfolio is down 2.6%. And our global macro portfolio, which does have a significant component of commodities with short fixed income and a couple of global markets that are performing well, is up 12.5%. S&P is down almost 8%. The Canadian aggregate bond index down 9%, and the NASDAQ down just about 15%. So we're pleased with how things are going. We aren't going to get complacent. We run our model every day. We retest all of our positions constantly. And to the extent we need to, we will raise cash. We will exit positions that stop working. But as it stands right now, it looks to us we're in the early days of a commodity bull market. We're in the early days of a reflationary environment. And ultimately, if the bond market can settle down a little bit as we get through this bond auction, we think it's quite possible that equities can bounce. So with that, any questions, Pamela?
We always have great questions, David. The first one comes from Paul in Toronto. He asks here, David, what effect, if any, does the Russian default on their debt affect the overall markets?
Well, look, certainly for large bond investors, if they have exposure, it would be problematic. We don't think it's a systemic issue. We don't think that they are large enough to have a systemic issue with the financial system. And certainly over the last year, many investors may have bought credit default swaps to protect against that. But I think that that's why some of the European banks have had a more difficult time. They may have some exposure. So it would be more sort of targeted impact rather than systemic.
Thank you, Dave. Next question. U.S. Financials ETF, ZWK, is down about 17% in the last couple of months. Does David think this trend will continue? What are your thoughts, Dave?
Look, all we can do is assess daily. As you know, we had a pretty significant financials weight coming into this year. And that was on the basis that we were seeing reflation take place in the economy. The way that the yield curve has flattened out has had an impact on banks. And with the sharp move higher in inflation and rates, there is some concern that that could have a negative impact on consumers. That's yet to be seen. But as it sits right now, the breadth models that we follow turned down a few weeks ago. And as we do, we use stops. We started reducing our weights. So we'll watch, and we'll certainly mention it the moment we see positive change taking place. But one of the things that I've learned is it's important to have sell discipline. And it doesn't matter what you think, it's what the market thinks that matters. And as it sits right now, there is money getting taken from financial services companies. Now, let's be clear, just a couple things. Certainly, sentiment is extremely negative in the market right now. And part of that has to do with the fact that most investors still have pretty significant weights in technology, which has really been a tough place to be. It also has to do with the fact that, the bond market that's been a giving tree for many years has really, really surprised some risk-averse investors to the downside. So with such negative sentiment, you get to a point where the market gets fairly sold out. And so we don't want to be averse to recognizing a positive change. We just haven't seen it yet in that sector. And we may well see a very good rally at some point in technology. But at this point, with the moving averages moving lower and breadth remaining weak, we have to be careful there too. So step by step, day by day, that's why we're doing these webcasts week by week. We can talk about what's changing and what's staying the same.
Absolutely, David. The next question here comes from Robert. He wants to know, what correlations, David, are you seeing between the movement of cryptocurrency and the market? Some say there appears to be a correlation between crypto and the NASDAQ. Do you agree?
I think that looks like it's the case. It actually looks like it's a more exaggerated move than it is for NASDAQ, large NASDAQ stocks. So it's something that we're watching very closely. The Ether and Solana and Bitcoin have held quite well above the lows from January and February and March, but they're being challenged. So it's something that we have to watch closely. And, I can tell you in our macro portfolio, we did reduce our weight. We do still have some position. As long as we hold above those lows from early this year, we'll probably keep that position. But in overall, relative to firm assets, it would be maybe it's 1.5%. If you keep it in perspective, crypto versus all investable assets is about 3%. So that would leave us with about a half weight. And we'll keep assessing that day by day.
Dave, we have one more question here. This one comes from Jay. He's curious. Some use the 2-year versus the 10-year when comparing the yield curve. What does Barometer consider the most important to compare?
Right. Well, we talked about this last week, and everybody looks at the 2-year versus the 10-year, but the reality is, as investors, we care about what's happening over the next 2 years. So I want to know the differential between a 3-year treasury bond, a treasury bill, and a 2-year bond, 2-year note. Because if we're looking at the curve, if 2 years from now rates are significantly higher than where they are now, the market's not telling you there's a recession coming in the next 12 months. Now, there is a very high correlation between the 3-month and the 2-year inverting, but we're not even close to that at this point. So that's what we care more about. We think it's what the Fed cares more about. But frankly, the Fed's job owning has been doing their job for them. As bond yields have been ratcheting higher, they will have an impact ultimately on inflation. And that might mean that they have to raise interest rates less over time, the more the bond market does the work.
Thank you so much, Dave. Well, that concludes the questions we've received this afternoon. And as always, I look forward to seeing you next week and wish everyone out there who's celebrating Easter, we hope the Easter Bunny is good and brings lots of chocolate. And for those celebrating Passover, happy Passover. Dave, I'll leave you as always with the final word.
Yeah. So when our equity breadth models turn negative, it always makes us a little bit more cautious. We have to look at all the underlying themes that we're focused on and ask the question, are they remaining in place? Is the relative performance remaining strong? Is breadth remaining strong in those groups? In the worst sell-offs, the strongest groups ultimately get hit. So we watch this very closely. So you can imagine we've taken a little bit of exposure down over the last few days as things have become a little sloppier. We're in a good position year to date. And frankly, our number one job is not to lose the money. So we're going to err on the side of being cautious, and we're going to look for what we can take from our market indicators. As it sits right now, we think the portfolios are in a good spot, but we'll assess it day by day. And you'll be the first ones to know in next week's video if we're seeing additional changes. If you've got things you'd like to discuss, either you're too shy to ask a question on the webcast, don't hesitate to give us a call. We'd be happy to chat with you. And until then, we'll talk to you next week. Thanks, everybody.